Hello, everyone. Happy Friday. It's been a while since I recorded the last video, and I wanted to record a new one on a new addition to the portfolio. And so, sure enough, this is a company that has been on my radar for quite a while. But, patience is always key when it comes to investing, certainly based on my investing style. If you've been following my journey, then you know that I like to buy high quality when it's marked down. And so Lululemon fits the bill, and that's why I just decided to add it to the portfolio because it got that cheap. It's and look, I think overall, I think this is going to be. I think if you take a long-term perspective on the stock, I think it's going to play out nicely. But for those of you, and I know some of you don't really know what Lululemon does, and so Lululemon is often credited with starting a new. So let me scroll back up because I did a full report. I shared the whole analysis on the company a few months ago, but at the time it was very expensive. But still, of course, so one of the questions that I always ask is whether I understand the business model or not. So I did the full analysis for this company, and it was on my watch list. The only thing that kept putting me off was the price, and now it's finally the time to start a position in the company. But yeah, so look, why do I like this company so much? Look, first of all, I love the trend. So they are credited with the rise of yoga pants and leggings. So whenever you see people walking around in their yoga pants, which is quite common, not only in the UK, but certainly across the world, that trend has been started with Lululemon essentially. So they have the first mover advantage in this market. And that's one of the reasons I believe they are well positioned to continue to capitalize on this trend going forward, right? So the company is renowned for its stylish and high quality performance. We're primarily targeting active and health conscious individuals. So I'm all about being healthy. I like to have that mindset. I certainly live by it, right? So I do a lot of workout. I work out. I love walking comfortably, and I just like the way I like the styling of the clothes. And even though they are targeting high-end individuals, right, the quality, so the quality of the fabrics is just exceptional. And ask anybody who wears Lululemon, and I know a few people, and they will tell you they will not trade Lululemon for any other similar brand, right? So look, that sounds a lot like a competitive advantage to me. But after delving deeper into the stock, that's exactly what I believe to be the case, and that's one of the reasons that that made me interested in this company. But so I was telling you from a fundamental standpoint what happened. So this is about the business model that we just described here briefly, and then there is more about it. So I just wrote a very article of the company. So if you guys are interested in having this report sent to you, no question to ask, just let me know in the comments and I'm more than happy to share it with you. But one of the things that I really like to see in a company is skin in the game. And so we want to see that management, we want to see that there is an alignment with shareholders, right? And sure enough, you can see that Calvin McDonald, this guy has been the CEO since 2018, right? So he has a lot of retailing experience. And perhaps even more interesting is the fact that he currently owns a lot of shares in Lululemon, which are currently priced at about $28 million. So we see a lot of skin in the game here. This is something that I really like to see. The CEO is someone who's been in the company, so he knows the company inside out. He's been with the company for a very long time, and that's what it is really. So So I like that. And another thing that really caught my eye is the fact that he has very good reviews on. So if you go to Glassdoor, and you can see that he has an 83%. I think approval rating. So 80% of employees would recommend Lululemon to a friend. Okay, to me that speaks volumes of management and how happy the employees are with the company. That means the company's culture is positive, is strong, and it's likely to continue that way. because the CEO continues to do a very good job. We will talk more about why the why behind the sell-off, but this is something that I really like to see. And sure enough, that ties into customer satisfaction. Look at that. From comparably, yeah, which is another side that I like to explore whenever I'm doing a research on a company. You can see that on comparably, Lululemon's customer satisfaction has an overall score of 86. That's very high. Okay, it tells me once again that the customer is very happy with their products, and that resonates with many of the people that I know who buy Lululemon's clothing. So yeah, it's good. Now, what's incredible about this company, and let me go back here to my spreadsheet here where I do all the necessary calculations to determine whether the company has a competitive advantage or not, is that if you look at the past numbers, I mean, look at this. So these are the big five numbers. These are the most important numbers, in my opinion, when analyzing a business. There are different metrics you can explore. I just think these are the most important ones. And so, for example, Royce tops all of them because it shows you how effectively management deploys capital, right? And you can see that the results for Lululemon are incredible. So this is a company that allocates capital very efficiently, right? And this is something that I really like to see. Okay, it means that management is doing a very good job at deploying capital, which is, in my opinion, the most important role. The most important role of a CEO is capital allocation, right? But let's have a look at the growth rates. So look at that. Earnings per share over the last 10 years has grown at 23%. At the last 5 years, 28%. Sales, so the last 10 years, 19%, last 5 years, 23%. And then operating cash flow growth rate, 25% over the last 10 years, and 29% over the last 5 years. So there's a lot of consistency here across the metrics, right? There seems to be a lot of consistency, which is something that I really like to see as well. It makes an investment, it makes this investment more likely. It makes this company more likely to perform the same way going forward. Don't take this for granted, of course, but I like to see this consistency in their numbers, right? And so, what is the main cause for the sell-off? The main reason why the company is now trading well off its all-time highs, and you can see that the company was not long ago reached a high of about $520 per share, and it collapsed all the way to about $228 per share. That's a 56% decline. The reason for that is because it's not that they didn't report solid earnings or solid revenues. It's just because they cut the outlook. So there are a lot of uncertainties in the world right now, especially on the back of Trump's tariff policy announcements. And because of that, clothing companies like Lululemon, that they generate about 40%, or they outsource a lot of their. They have a lot of. How to say it? They have about 40% of their products, right? They come from less developing nations, namely Vietnam and so on and forth. And because of the tariffs, that can ultimately impact their profitability, right? Because it means it's going to be more expensive for these companies to continue to do that, to continue to manufacture, right? Their products in these less costly nations. And so anyway, that of course affects the projections, the outlook, and that's why the stock ended up declining 20% not long ago on the back of the earnings report. It really spooked investors, but I do think I do think over the long term there is nothing. I don't think there is like a fundamental issue with the company. I think these are macro headwinds that can play around over the short to medium term, but long term, I think there is a lot of growth potential for a company like Lululemon. Okay, and sure enough, they generate a lot of their revenue in China, and they are expanding, and that's something that I really like to see. And that's also part of the reason why I decided not to buy Nike. You see, if you look at the market cap of Nike and compare that to Lululemon, Nike is all around the world already. It's a well-established company, even though it has significantly declined from the all-time high. Number one, it's not as priced as attractively as Lululemon, and number two, I think from a long-term investment, I think it makes more sense to invest in a company like Lululemon, which is far more profitable, which allocates capital far more efficiently, and has far more attractive growth prospects. Okay, there's a lot of expansion to do, so I like that. And not least, unlike Nike, Lululemon focuses on this, targets a very specific niche, right? Nike is all over the place. So they have shoes, they have footwear, and all of that. Lululemon is more the athletic apparel trend, and that's what I really like, because it's really something that I can relate to. I like the product mix. So from an investment standpoint, guys, one thing that really jumps out at me is the fact that if you look at the 10-year PE, let's have a look at the fundamentals. So I'm looking at Stock and Lock right now, and let me go here. I want to show you something. This is probably the lowest valuation the company has ever traded at in its history. Look at the operating cash flow, right, compared to the price to operating cash flow. You can see a disconnect between both these metrics, and this is something that I like to exploit as a fundamental, as a quality driven investor that focuses on margin of safety and valuations. I like to explore that disconnect. That's where opportunities might lie. And you can see that, for example, the price to operating cash flow has been declining, while the cash from operations has actually declined substantially, even though it has come down a bit. But there is definitely a big gap between price and the operating cash flows, right? And you can see, going all the way back to 2014, you can see the cheapest the company has ever traded at, was, let's have a look, at 12 times operating cash flow. And right now we are at 14 times. So we are nearing all-time lows on this metric. And if I check the net income, so the EPS, let's have a look at net income. Okay, and price to earnings, and you can see more of the same. Look at that. Net income has continued to increase, with only a small decline recently. In fact, it's just at the same level, while price to earnings has declined sharply. Okay, another big disconnect based on this metric. And look at this. The lowest the company has ever traded at was exactly today's valuation. Okay, this is an all-time low for the company, going back all the way to 2013. And then the reason I'm not checking cash flows is because Lululemon has been investing a lot recently. The company has been investing a lot recently, and so you can see that there has been a sharp decline from about 1.7 billion to 1.3 billion. And so I'm focusing on net income and operating cash flows when it comes to assessing the valuation of the business. And look, I wanted to share this with you. I believe it still is a solid company. And I think today's valuation is very attractive. So, for example, you know that as a conservative investor, let's say I want to recoup. This is something that I learned from Phil Town at rule number 1. And I'm going to use, instead of free cash flows, I'm going to use, so this is Lululemon. Let me have a look. operating cash flows. Let's use net income. I think it will probably make more sense here. And let's say we want to recoup our investment. Yeah, I'm using it right here, as you can see. So this is the latest net income. Let's say you want to recoup your investment in about 10 years, right? Assuming you are buying the entire company, because that's what we do. We like to think as business owners. And so if you were to buy the company today, how long will it take to get your money out of the business if the earnings were going to grow at about 12% over the next 10 years, 8 years? And the answer is, so the price you should pay should be around $200 per share. Okay? So this means that if the company manages to grow its earnings at about 12% over the next 8 years, yeah, it means that we will be able to recoup all of our investments in about 8 years, which is exactly what we want as someone who's buying publicly traded companies as though they were trading at a private company, okay, which is about 8 times earnings, as opposed to a publicly traded company which typically trades at 15 times earnings. So this has already a built-in margin of safety. And so the price you would pay is about $200 per share. What's the price today? That's about $228 per share. My goal is to start. I bought a position at 228, knowing that the value, so the margin of safety price sits around $200 per share, and I intend to continue to accumulate as if the price continues to come back down. Okay, so I can lower my average cost per share, right? So yeah, this will bring my cost basis lower, which is something that I like. And by the way, analysts are estimating earnings to grow at about 11.28%, as you can see right here. But look, I'm being already very conservative by assuming 12% growth going forward. Look at the past growth rates, guys. It's just incredible. Look at book value, 16% over the last 10 years, 20% over the last 5 years. So this is a sharp decline, yeah, but it's already very conservative. And analysts are assuming 11-ish. So I'm settling for 12%, which I think is still very conservative. And based on those assumptions, the average, the margin of safety entry price should be around $200 per share. Okay, so look, I love this company. Look at the margins of this business. Look at the gross margin, 60%. Operating margin, 23%. Net profit margin, 16%. Look at that. Okay. Look at capital intensity. Typically, I like the CapEx, so capital expenditures, to be less than 5% of sales. That's certainly the case. You look at cash to operating cash flow, still very healthy at 23%. So look at that. This is a company that has almost no debt. Okay, so what does the debt to free cash flow of about 1.30 tells you? It tells you that if the company wanted, it could pay off all of its debt in less than 2 years of current cash flows, of current free cash flows. Very healthy returns on capital and profitability metrics, and very healthy valuations. Now, the icing on a cake, we already know this is a great business. Now, it's not going to be a great investment if you end up overpaying. Look at the average PE of the last 10 years. That's about 42 times. And today, the company trails at a trailing PE of only 15 times. So look, I have a big margin of safety, and I decided to make Lululemon my 6th portfolio allocation. It's the sixth position in my portfolio. I will only own between 6 and 8 companies. So let's see if more opportunities arise. But I'm very happy with my portfolio positions. I'm outperforming, as you guys know. You can see if I go here to the portfolio and if I go to the performance, you can see that I'm definitely outperforming with a 32%, and I think this is just the beginning. I think as some of my positions play out, then the rate of return is going to go up as well. Okay, I own high quality businesses trading at low valuations, which is a recipe for success based on history. So let me know if you like this video, and if so, I'm more than happy to continue to share similar videos with you guys. And let's see if Lululemon continues to come back down, so I can add more, so I can make it a full position, right? So yeah, let me know if you liked it.